Welcome to the Abidi Stock Market Learning. The beginning is most important. In this video, we are going to teach you a candlestick trading rules. Since ages, because of the integral nature of a signal, some basic rule can help an investor maximize the profit. These rules were developed because of profit that were created by using the signals. Acting against the signals provide the clear lesson what not to do. Some of the rules are derived from the Great Alteration the Candlestick investing program provides for the investment thinking. Having the ability to identify the reversal signal creates an extremely beneficial dynamic for investor. Once an investor becomes comfortable that the signal represents a high probability situation, investment trading rule can be better followed. The elimination of emotion, especially fear and greed, should be the prime goal for investor. The biggest failure factor for the most investor is the emotional element. Investment trade become twisted with investor buy hope versus what indicators are telling. Every time an investor put on a position or take off a position, a mental decision process has been made. Our mental decision process, our ego come into play. Of course, we are all smarter than the rest of the world. That is what we all like to believe. To confirm that, our mental process become qualified every time an investment decision is made. To buy a stock and watch it goes down not only hurt the wallet but also hurt the ego. When we are right and get into the position of a big profit, our sell parameter become liquefied. In this video, we are going to discuss the 12 candlestick trading rules in more detail. Moving on to rule number 1, built-in discipline. The candlestick signal produces a high probability format for when it's time to buy and when it's time to sell. Utilizing that format creates a self-imposed discipline. Why trades against the probability? As we are often told by the professionals, you cannot time the market. The ability to see high probability potential reversal in the market trends allow an investor to apply the simple trading rules. These rules have been derived from many years of experience investment from the numerous sources. It also incorporates the rules of specifically applied to the use of candlestick signals. Since investing has become a more active part of people's life, the mental status of an investor as well as a mechanical imposed discipline is important to successful investing. Move on to point number 2. Incorporate good investment procedure. Just like any profitable attempts, investing required a structured business plan. Successful money manager establish a set of business discipline. Money allocation, trading environment, consistent evaluating process, and clear and concise planning are all required to maintain a good mental analysis process. The analysis of candlestick signals and patterns, all through a primary element of a successful investment programs, still required a business atmosphere for the successful implementation. The trading area should be organized, whether at the business office, a home office, or working on laptop. Avoid distraction by surrounding. This allows for a better evaluation of investment signals and patterns. Move on to rule number 3. Document winning and losing trades. A well-maintained accounting of transaction and writing the result of good and bad trades in the journal is a good investment habit. Having a journal of what the thought process were during a good or bad trade situation frees an investor mental energy for analysis as opposed to try to remember the previous trade occurrence. The mind is an unformulated entity. Important factor that should be remembered can often slip away through the time or be lost when tried to analyze the massive amount of information. Having a documented journal of the past trade allows an investor to refresh the memory on what worked or did not work in the past. Keep a journal at your workstation. Move on to the rule number 4. Do not trade when not feeling well. Investing requires the clear mental thinking. Most people experience the different mental outlook when feeling under the weather. Having a bad cold, flu, headache, or a multitude of other sicknesses can dramatically affect an individual's outlook. Take a break. Getting mental refresh is often crucial aspect for thinking clearly. Investing does not require participating in the market every single day. Investing should be taking advantage of market conditions when the investor want to participate in the markets. There are times when the market is not moving well enough to produce the profit that would permit spending time and energy. Go relax, reset up. When you come back after a few days of rest, the analysis process should be clearer. Move on to rule number 5. When in doubts, get out. The candlestick signals have the high probability of making profit, but not all the signals are going to result in gain. Hopefully, 3 out of 4 will be profitable, even 4 out of 5 is obtainable, but that leaves 20 to 25% of all the trades that does not works out. You need to understand when 1 in 4 or 1 in 5 investment situations are not going to work, when this situation become apparent, or if the analysis of the position does not have clear directional indications, get out. Why stay in a trade that have questions surrounding it? Take that money and put it into the next batch of clear candlestick signal situations. A questionable trade situation does not put the probability in your favor. Liquidate it. There will be a plentiful supply of signals waiting to be evaluated at the end of the day or week, or whatever time frame you are investing. When in doubt, get out. There will be many places where the probability are clearly in your favor. Invest your fund there. Move on to rule number 6. Don't look back. Why doubt it? If your observation and the best of your investment decision processing tell you to liquidate the trade, don't fight the percentages. If the price skyrockets after you have closed the trade, you still made the right decision with the information you had at that time. If sign says that the holding position was a low probability situation, what the trading program dictates. If a buy signal reappears, buy back into the position. Otherwise, those funds should have been reallocated to the position that have been upside probabilities. Don't look back. Make the best decision you need to be with the evidences you have at that time. For every instances when look back create distress, there will be a dozen's time that you are thankful for taking the right action when you did. Move on to rule number 7. Plan your trading. One's careful study determines the order of the best potential for the next day. Keep that order. If the top 1 or 2 stock open in a manner that does not demonstrate the continued participation of what the candlestick reversal signal was indicating, then look at the next best positions. If the market open in the manner that make all the potential unlikely to be a good trade, just stay out. If a strong bearish open was not what was anticipated for the next day, then keep your investment fund on the sideline. Do not attempt a short of shorting. Sit back and get ready for the next day. It is better to miss the potential profit than to have a make up losses before being able to get to the profitable balance. Move on to rule number 8. If a trade is not working, move on. Not all trades are going to be instant winner. Always keep the probability in mind. A vast majority of the trade should work, some will not. If a stock price does not confirming the signal, whether the next day or the 3 day after the trade has been placed, do the same evaluation that should constitute the underlying permissions of your investment program. Is this the best place to have my investment funds? The only important decision process should be whether the signal was going to produce a profit, not what happened with the position in the prior few trading days. As a result, keep the investment fund in a trade that have the best potential. If an existing potential is not performing as expected, move on to the one that have the potential to the maximum profit. Move on to rule number 9. Don't allow the news to influence your trading decisions. A major influences upon the investment world is the easy access to investment news. News channels are on all day long. Keep investors bombarded with every piece of news. Reported news is the actual reporting of the news that someone has know about for a day, week, or a month. Do not make different investment decision based upon the investing of the news. If you invest based upon the principle of the candlestick formation, then trust that the formation to lead you to the successful circumstances the vast majority of a time. Move on to rule number 10, candlestick specific rules. Under, under different circumstances, the rule would be wait until the end of the day to see what the candlestick formation was making itself known. There will be a good many instances where the trade has been put on based upon the presence of the candlestick signals. The purpose of establishing a position was due to the candlestick signal, a completed candlestick signal. An early day pullback during the long position uptrend or the price bounces occurring during a downtrend can be a normal buying and selling forces at work. What goes on during the candlestick formation, the time frame is not important. It is the final price of that time frame that will demonstrate the cumulative result of the investor sentiment. An important rule is to make entry and exit decision based upon the candle formations that presents themselves at the end of the day. Move on to rule number 11, the doji at the top. Always sell when you witness a doji at the top. If the doji does not represent that exact top, which an extremely high percentage of the time it does, it indicates being of all sales at this price level. Money could have been placed elsewhere for the same, if not better, returns without the potential downside exposure. Move on to rule number 12. Stay with the rules. Always let the market dictate your course of action. Maintaining the simple rule, always keep result accountable. Keep basic rules allow the investor to keep from letting emotion reaction interfering with the disciplined trading practice. The statistics will be the guiding force of your discipline. That's it for the video. You should take your time to understand all the concepts discussed in this video. Take your notes and go back from time to time to review the strategy which has been shared with you. Please subscribe to our channel and click on the bell icons to get the notification for our upcoming videos. Please like the videos and provide your comments if any. If you feel the content of the videos are knowledgeable, then please share the videos with your colleagues and friends. Thank you for watching this video.